Join me today as I sit down with Kim Arthur, CEO and Portfolio Manager with Main Management. We'll look back at 2024 and see what lessons we can learn so we can make 2025 a more successful year. So once again, welcome back to Beyond Tomorrow, and I'm joined today with an amazing friend and someone who's been able to really help Asset Management Group as a firm and our clients, and just someone who has a wealth of knowledge that is a two-time visitor to Beyond Tomorrow, Mr. Kim Arthur. How are you doing?
Well, Mo, thank you very much for that generous introduction, and it's a pleasure and honor to be back here again with you and your firm, and really appreciate the partnership that our two firms have in trying to find the best possible solutions for your clients. So awesome to be here. Looking forward to catching up and talking about 24 and about what can happen here in 25.
Of course. Well, thank you. Well, I know everyone asked about New Year's resolutions. We talked earlier, and you mentioned your resolution is to breathe through your children's problems. I mean, you have 5 kids, and the youngest one is what, 15?
15, correct. Yeah.
And my youngest one is 14. So we're kind of in the same boat. And, as the kids get older, problems get a little less, but they get a little more, I don't want to use the word severe, but they get a little more dramatic. How about that? We use the word dramatic. And my resolution is to read a book, at least one book a month. So hopefully we're both successful in those endeavors. But as we look, as before we get too far into 25, the reason why we wanted to have you in today was to look back at 24 for a minute and just make sure that we really comprehend what really transpired in 24 and making sure that we're in the right positions moving forward for 25. So I like to start off with, if we look back at 24, what do you think were the key market trends that you found most impactful? And what surprise market developments did you see in 24?
Yeah, that's a great question to start things out with. I think the biggest kind of trend that everyone was focused on is the Fed had been raising rates in their rate policy for 2 years, starting out in 22 at 0 rates, and they brought them up to 5.5%. And
Okay.
then the second half of the year, they lowered those rates by 100 basis points in spite of the fact that you had the economy growing at 2.7%, you had full employment at 4.1%, and you had a very robust stock market. So that was there had a lot of impacts and a lot of people kind of trying to figure why the Fed was being so aggressive on the rate cuts. Because remember, relative to zero, the rate cuts seem pretty normal. But relative to if you go back in time, the Fed funds rates are very typical around a 4% level, which is where they are right now, 4 and change. So I think that was a big thing. And then I think the surprise that caught everybody off guard is the economy, again, I mentioned, grew at 2.7%. Everyone, the street, had a guesstimate of 1%.
Wow.
1% to start the year. So that's why they missed it so far, and that's why the S&P was up 25%, is that earnings kept kind of being revised up with this stronger GDP. Now, that 2.7 on GDP kind of gets you to where we are. Historically, we've been at about a 3% rate, so you're just slightly below.
1% versus 2.7. I mean, were they just being bearish, or do you think there was just, like, what do you think caused that such of a disconnect between the reality and their expectations?
I think people were geared again for a recession, which they've been predicting a recession since 22.
Right.
They kept saying 23 was going to happen, and they just kind of carried it over. So I think that was the biggest thing. They thought that you would have a recession and that the Fed would not orchestrate a no landing. And in fact, the Fed has so far orchestrated a no landing, and that caught them off. Now, this year will be interesting. I know we're not talking about
Sure.
this year yet, but the bogey's been moved up to 2% for the
Okay.
GDP, which is still below the historical, but you can see people reluctantly trying to become a little more constructive.
Yeah, the theme of recession, or the conversation of recession, has been muted much more lately. I mean, I don't hear that. I don't hear the thoughts of a recession anymore.
Yeah, you're exactly right. Historically, in any given year, the chances of a recession are about 15%. Where do they come up with that? Because once every 7 years, on average, you have a recession.
Right.
So that's kind of your starting case. And I think to your point, this year, most people have somewhere between a 15 and 20% chance of a recession, i.e., it's no recession.
Okay.
So yeah, it'll be interesting to see how we unfold as the year goes out.
Now, were there any policies or monetary policies or fiscal policies that were probably underlooked that transpired in 24?
Yeah, I think typically when you're in, like, last year was the second year of a bull market. Again, that economy we talked about at 2.7%. Um, Typically during that period, you should have contractionary fiscal policy. We had expansionary. And unfortunately, the expansionary happened all on the expense side, where we went, instead of a 3% deficit that we typically historically have run, where revenues have been 17% of GDP and the expenses have been 20. We ran the expenses at over 23 points. So we had a 6-point deficit. So that was very, very different than most bull markets. And when you're in an expansionary economy, that probably can't be sustained. So we'll have to see some changes that happen around that. And then, a lot of the growth happened in the headcount and employment. It was happening in healthcare and in government. Neither one of those are known for productivity enhancements. And yeah, all the other ones that there was, like, kind of like flatline headline there, they're pretty good at productivity.
Yeah. Um, yeah. No, that's a good point. Yeah. I mean, if you look back at different sectors in the market, I mean, this is why, when we look at positioning some of our clients, we want to make sure that, yes, we're especially for our growth clients, that we're constantly invested, but we're also looking at different sectors for us to be positioned in that could be overweighted in different market conditions and underweighted in different market conditions. And healthcare and government, healthcare, energy, technology last year were pretty strong sectors to be in. And 25, we'll see. I mean, today, just as we were recording, we're starting to see a bit of a pullback in the tech space because, I guess, new developments in China. And so that's why it's always, for us, one of the reasons why we like working with you is because you feel you have a great way of looking at different sectors in the market and then just making sure that you're ahead of the curve. And so I'm glad that you mentioned that. So now let's just look at 25 again. I know it's only been a month, but if you were to look forward to 25, I mean, what are maybe two or three big topics or big outlooks that you see moving ahead of us for this year?
Yeah. So I think typically this would be the third year of a bull market. And if you even kind of define it and put it down more to the first year of a presidential cycle, in the third year of a bull market. So you kind of like take that funnel and you have it wide to begin with and you narrow it down. Typically that looks like an up 12% year. And it obviously doesn't tell you about what sectors are going to do good and which ones are going to do bad, but you do have a pretty good tailwind at up 12%. And that typically looks like a first quarter up a couple percent, then you get a little more strength in the second quarter, and then you get a little bit of a seasonal sell-off in the summer,
Mm-hmm.
and then you finish strong at the end of the year. So that's the playbook. I will tell you, last year it played out to a T. The magnitude was much bigger than a normal fourth year of a presidential cycle in a bull market. But the shape of the curve was exactly the same. So
Okay.
that's one of the things we look at, obviously not the only thing. So I think we have a little bit of a tailwind. Again, third year of a bull market. Typically these bull markets are, 4+ years in duration. So we still have a couple more years left in it. But it's going to look a lot more with earnings growth
Mm.
because our multiples now we're up at a little over 20 times. And so you're at a rich multiple, and we can tackle this later, but if I always like to say, are you willing to pay more for a company that has higher margins or pay less? And the answer is you're going to pay more for a company with higher margins because you can get your payback much quicker.
Right.
The margins in the market 24 years after 2000, when we had peak PEs of 23 times, we're at 20. Right now, we're less. The margins are 2 times what they
Wow.
were in 2000. So these are very profitable companies. And I think that's going to continue as we go through with different technological upgrades there where we can be more productive with fewer people. Bank of America's CEO, Monahan, last week when he was in Davos in Switzerland said, I'm running my firm on the same expense structure as I was 10 years ago with 30,000 fewer people. And the next
Wow.
10 years, I won't hire another person. I've got 213,000 people on my payroll. I will not hire another person in the next 10 years. They'll be doing different jobs than they're doing today. They'll
Right.
have to be retrained. But that's sort of the window, I think, looking forward and why these margins can continue higher.
Wow. I didn't hear that comment from him.
Yeah.
That's
Yeah.
pretty
He's
interesting.
and I like him because he has if you ever want to get a window into the consumer, he's got like 70 million depositors that are all kind of middle America consumers. So he's got some really good data that he puts out. I definitely, look at his bank and his management style. But yeah,
Mhm.
I thought that was a fascinating comment.
Are you seeing that in the portfolio management space where maybe firms, or maybe not particularly your firm, but firms in general, are maybe scaling back on bringing new talent because they can use some form of artificial intelligence, some form of language models to either do research, to do trading, or to fill in the shoes of another human being? Are you starting to see that in your world?
Well, you mentioned earlier here about the Chinese AI DeepSeek,
Right.
which, that started it's a large language model that they presumably started in May of 2023. And it's open sourced, and they're claiming that for $6 million, they're achieving artificial intelligence that's helping them run their quantitative portfolio. They've got like $8 billion that they manage, and they use AI to manage the money. So that would clearly be somebody that's using it. I would put the asterisk that they do have a heavy oversight from the China's Communist Party, who's not known for transparency. So
That's a
I think
shocker.
I would, yeah, it's a shocker, exactly. So I would be a little skeptical about, what they actually use to build that. They could clearly have used a lot more money and time. But anyway, so yes is the answer. We're even seeing just internally, Mo, that we're using AI when we have as a note taker, when we have client conversations or we have internal meetings. That works out very well. We've got in marketing where we're using AI. Shelby, our chief marketing officer, she's using it to help her out with text creation. And then myself, I'm using it from a thought partner standpoint. So
Okay.
you look at AI and you say, all right, I want to have, you also being the tip of the spear for your firm, you have to think strategically.
Right.
And one way to think strategically is to say, I need thought partners to bounce ideas off of. And AI can be very good if you can kind of give it the context, the role, and then ask it to interview you and say, hey, give me 5 questions. And then from that interview, you would then go out and you can go ahead and create a to-do list, a task list.
Hmm.
So I can see here that we're going to continue for ourselves and other friends of mine that are in this business. They're going to ramp up their productivity with fewer, more efficient bodies and a lot more leveraging of technology.
Yeah, we're dipping our toes into to AI. Just same thing as as a thought, to as a partner when we're thinking about ways to write articles, ways to even do something like a social media post, right? Something as
Right.
simple as that to how to, our team we have a lot of members of our team that are out of the office. And so
Yep.
some of the emails that we have, we want to make sure it gets funneled in the right place. So we're using different tools to make sure that all the channels are all the messages are being delivered in all different channels. So yeah, it's one of those. It's a technology that has a place, and
Yep.
as of right now, I don't see it going anywhere. And I think that's still going to be a theme for me personally. I think that's still going to be a theme for 25.
Oh yeah. Oh, yeah. Well, I think on that point, if you kind of look at the adoption, it's been more on the consumer side with ChatGPT and all the other derivative plays from the other players there. But on an enterprise level, it hasn't even really started. Even Microsoft with their Copilot, that's all consumer driven there. So that's why I think, to your point, the next 4 years is going to be massive adoption in the enterprise, and that'll be driven like every tech cycle, prices coming down dramatically, and all of a sudden it becomes ubiquitous. Where in 5 years, it's table stakes. You better have AI throughout your entire firm, and everybody better be up to speed on it there, because otherwise they're going to be gone.
uh, so if estimates are looking at GDP to be, I think you said what, 2%.
Yep.
Not to be the bearer of bad news, but
Yep.
what concerns or obstacles do you foresee could have us have a lower GDP than 2%?
Yeah, that's a very good question. So I think if we got into some sort of a tit for tat tariff trade war, I think that would be detrimental, because it would clearly not benefit either side of the table. So that would potentially be something. I personally believe that President Trump is a negotiator, going back to his Art of the Deal book that he wrote many, many years ago. And that's his play script. So I think it's more of a negotiating tool, and we'll see, more of that negotiating, and we'll get people kind of coming to the table in a constructive fashion. But I think that there's it. It's always what I always look at here, and this is it's not an answer that people want, but it kind of it's it's the things that nobody is talking about, that you don't quite know. Those are the things that upset the apple cart.
Mm-hmm.
And the problem is you don't know what it's going to be, because nobody's talking about it. Typically, when they're talking about things, the market begins to digest it and begins to discount on what's going on. So I think that uh, um, uh, I think one other thing that, and it looks like it may not be an issue, but our three things that we're concerned about for what you're saying, it's the dollar. Okay, if the dollar is strong, that's going to be a problem. Now, the dollar is actually down 1% on the year to date here. So we're 1 month into it, and it's down 1. If you look at the average currency strategist at the start of the year, they had the dollar flat for the full year. And then you've got that bookend with people like Goldman thinking up 5 on the dollar percent, and Morgan Stanley down 5. If you had an up 5, that's going to hurt the S&P earnings. And that would probably hurt them on the magnitude of about 4%, if that were to happen. That's not our base case, but that would be one thing. And then the other thing is what we talked about with the federal government. If we get a little bit of contractionary on that fiscal side there, where we have a deficit that goes from 6 to 3, let's say, or 6 to 4, something down, that's a little bit of a headwind there. I do think you could get some productivity enhancements out of the government if these guys are now they got big headwinds with. So that, and then so those are kind of the two key pieces there. I think kind of the dollar behaving well, and then the government not kind of like really contracting very, very fastly, and then those tariffs tits for tats.
Okay. You mentioned the word behavior. So, I've been reading some of Daniel Crosby's work. And,
Yep.
part of the work that we do as financial advisors is not just the money management or the portfolio construction, but it's also helping clients behave properly in volatile times and in bull markets, right? It doesn't have to necessarily be
Yep.
volatile times. So, what advice would you give someone who's listening to this, who and heard everything you said, and are either wants to make moves in their portfolio just based off of some of maybe fear, right? Fear that we've had 20 plus years in the market, and we have a new administration, and GDP is going from 2.7 to maybe 2%. And so maybe there is a reason for them to maybe look at reconstructing their portfolio, and it's just based off of maybe just fear. What advice would you give someone to maybe, to on the behavior financial side?
So what I would give to them for advice is call you up and have you walk them off the ledge. That would
Uh,
be my best. And that's why I think, the work that you do is the yeoman's work there. I mean, it is phenomenal, the service that you can provide, because you know that um, fear is temporary.
right.
Greed is permanent. And I say that not in a nasty, like, greed kind of people get worried. I'm just saying that the stock market over time goes up high single digits. And it goes up during good times, like that long-term trend, you see it powering ahead, and it goes through all kinds of problems. And that's because what the humanity is, a optimistic group of people always trying to find improvements and better things. And I think you've got a great perch to be able to counsel those people. And when they're getting ready to do something emotionally, which typically means it's going to be irrational, you can sit there and remind them, first of all, it's a two decision step process. When you go to sell something, you have to reinvest it at some point, going back again with stocks being up high single digits, low double digits, compounding over time. And then just to remind them again that this too will pass. I mean, we saw that last year in 2024 with the election. Everybody was scared to death. It
It
passed.
passed.
And it passed. And one of the things I like to remind people about is that the government's only 15% of the US economy. That means the private sector, people like yourselves and Andrew, you're 85%. I'll take my bet on that 85% all day, no matter what the 15 does, because you're smart enough to figure out that you'll adapt to what the 15% dictates to you through regulations or whatever happens. So my advice to that person who's ready to, they're sitting on the edge of that proverbial ledge there, call you up and you're going to talk him back in.
Yes, that was a nice plug. I appreciate that. That was a good plug. Uh, well, we have clients that have asked us about diversification, right? They understand the correlation of stocks and bonds. They have ETFs and mutual funds. They have that inside their portfolios. But when they're asking us about alternative classes and alternative investments, we have our view on, for the right client, there are certain alternative investments that make sense. But in your world, if someone's looking to diversify their portfolio, can you give me an idea of, alternative classes and alternative assets and how they might fit in someone's portfolio?
Yeah, definitely. I think the first and key, and it's no different with alternatives than it is with equity exposure and fixed income exposure. Cost matters. So you've got to make sure the alternatives probably have the biggest range of fees just because it's got that catch-all bucket as alternatives. And typically, like, you think about the big traditional bucket of hedge funds. First of all, you have to be a qualified investor historically to get into them. There's high minimums. But what they don't talk to you about is they're very tax inefficient because they were built for institutional money, which is non-taxable. And they've got outrageous fees. It really is a compensation structure for the manager or owner of that. And that's come to light over 30, 40 years. It took a long time. So I think the first thing, to make sure for the clients that you have an alternative where the fee is reasonable and that your hurdle rate you can get up and over and it's tax aware. We're a little biased ourselves. We like doing a call writing strategy, which is basically it looks a lot like high yield, but with downside protection. And that is something where, high yield is attractive to people because you get paid 3, 4, 500 basis points more than treasury. So that's your kind of cushion. But if you can marry that with something that can get you that same premium over treasuries, 3, 400 basis points, plus give you some downside protection from the manager, then there's probably a place for that to live between fixed income that is investment grade and equities that are growth to have that happen. And then there's all kinds of other alternatives from private credit to different things in real estate. But again, I think the key is what's the cost? What's the all-in cost? And what's the tax impact?
Mm-hmm. Yeah. It all comes down to cost, right? I mean, it is, you never want to be on the wrong side of the trade, or wrong side of the, and I forget who said it, but I know it's a phrase in real estate, but the the win is in the deal, right? And so the money is, or maybe it's the money is made in the deal, right? At that point, if you have a bad deal from the beginning, then it's hard to recover from it. And so if you're overpaying for an investment and the return is just not comparable for what you're paying for it, then you're already on the wrong side of the table.
It's 100%. Someone reminded me the other day of real estate. It's something that President Trump did many years ago. He had the Plaza Hotel where he couldn't give it away. It was during a cycle when the market was down, real estate was down. He couldn't. It was probably when he was on paper broke. Or more than broke. He probably was a couple $1 billion in debt. And a very wealthy Chinese family came over for the Plaza Hotel. And what he did, they wanted to buy the Plaza Hotel, but he realized he turned the script on it. And he had a bunch of raw land that he realized these guys are the wealthiest family and one of the wealthiest families in Asia. I'm not going to sell them the Plaza Hotel. I'm going to sell this much bigger deal and then have a development of that property that I can help develop. And that's what he did. He kind of like pivoted. And you're like, that was good.
So as we, and by the way, thank you again. Thank you again for your time today.
Yeah.
Really appreciate it.
Of course.
So looking at the next big thing, right?
Yep.
If you can put your thinking cap on, where do you think maybe either the next emerging market or the next technology that you're most excited about that you think could potentially be a game changer for the industry?
Yeah. So I think going back to what you and I were chatting about before, I think AI is in its infancy, that we're really going to see the true benefits as we scale this up into the enterprise. And it'll be from drug discovery, taking the time for drug discovery down dramatically. We're going to see this in the industrial companies there that are going to have much more in automation that's going to happen. So I think AI, I think automation. I'll give a quick little plug here. My wife just recently got a Tesla.
Okay.
And I drove this the other day, Mo, and the new version of their full self-driving came out in December. And I read a bunch of blogs on people that had been, drivers of the full self-driving since 2018, so 6 years. And the improvements that happen in this version 13.0 here are insane. I got behind the wheel, and for 3 hours, I had it full self-driving, and I've never felt more comfortable in my life. Sitting there, no foot on the pedal, no hands on the steering wheel, going on and off the freeway, going through traffic cones that this thing maneuvered around perfectly. Mo, I was like, I can't believe this thing here. And so I think that this automation is just getting going. It's just getting going. So you get the robotics, the automation, the AI that plays into it, and you still have to have the enabling from semiconductors and software to be able to have that automation work. So I'm very, very, very excited. And I know a lot of people say, well, Mo, what's going to happen when you go to work in an autonomous vehicle, and you have at your house, you have a robot that is, taking care of the cleaning and the dishes and whatnot. And you start getting this thing where everything is non-human. Well, I think it's going to make yours and mine and any people that are in the relationship business, it's going to make our value add even higher because humans crave other human relationship
That is
there.
so true.
And they're going to like the efficiencies, right? So they're going to come and say, Mo, can I just lean on you and talk to you? I've been with a robot for the last, like 14 hours.
Ah.
So I'm excited about both of those trends there: increased relationships and increased automation.
I love that. I love that. Yeah, in our industry, there was a phase of the robo advisors, right, where
Yeah,
where someone could literally work with at the end of the day, a robot, right, an algorithm to help them with their planning, and that had a little run for a while. But I think
yeah,
that has simmered down because you're right. Clients, especially in something as serious as their financial lives, not just for
yeah,
2025, but the life that they want in 2030 and 2035 and for their grandkids, right? And the legacy
yeah,
behind them. They want to make sure that they can see a person face to face, look them in
right.
their eyes, shake their hands, have that relationship, know that, you know, worst case scenario, God forbid, if I passed away, that
Yep,
not a robot's going to speak to my
yep,
wife, but the person I've
yeah,
built a relationship for 20, 25 years is going to sit down and walk with my wife through what's next. And
exactly.
so at in the beginning, I won't lie to you, Kim. I was a little worried about what these robo advisors would do and how they would maybe change the industry.
Yeah,
But as the years have gone by, I've realized that the relationship that people want, the human connection, isn't going away
yeah. No,
at all.
100% agree with you. 100%.
Okay. Well, as we wrap up, I yeah, the show is called Beyond Tomorrow, and at the end of the
Yep,
day, the premise of the show is that the life that you want in the future is based off of decisions that you make today. Okay,
yep.
so I'm raising two teenagers at the house right now, and actually my second oldest son is interning with us. I had tried to figure out where he
Oh,
fell in the in the pecking order, but he's interning with us now. He's 18 years old, and
nice.
had a conversation with him about his next step in his life. As far as going to college and making the right decisions about which school he goes to. But one of the things that he asked was balancing work and life.
Yeah,
How do you do that? So for you, and for our audience, when you think about the life that you want to live 5 years from now, how do you personally balance work and everything that Maine has to offer and life?
yeah. No, that is something I think about all the time. And what comes up is health is the very first thing. Because if I don't have my health, I can't take care of anyone else in my family, which brings up family number two. So it's health, family, then the business. Now I
Hmm.
know, we are a business of client first, but I think every client that we have appreciates the fact that if I don't have my health and family, I'm not going to be the best that I can for them. So those are the two, that's the pecking order: health, family, then business. And what I do, there's a like anything that's good, it's you got to borrow it from someone else. And so I borrowed this acronym from someone. It's called SHIELD. It's like a protective shield, SHIELD. And each one of those letters stands for something that I try to focus on a daily basis. So the S is dealing with stress. We all have stress in our life, whatever it is. You must be aware of it and find something that works uniquely for you. The H is for your health. So if you don't have your health, like we talked about, you can't take care of your family and your clients. The I is for interaction.
Mm.
And interaction, particularly as you get older, you need to constantly stimulate yourself, and you must do it with interaction. They've got all kinds of studies that show its lack of interaction will lead to Alzheimer's and dementia for people as they get older. The E is exercise, which obviously feeds back into your health. The L is another key component, learning.
Mm.
It's learning just like you're doing here. You're going to read a book a month, which I think is an awesome goal there. You're going to be learning constantly. And you're never too old to learn. And then your D is your diet that goes back into in conjunction with your
Yeah.
exercise that leads to your health. So it's a great little acronym that you can kind of like check in with yourself and say, hey, am I doing all these things? Do I need to kind of like, turn the dials up on a couple of them, turn them down on a few others? But that's for your son. And I tell my kids the same thing, that, that is the way for longevity and to, like you said, I love it. Looking out for 5 years, like, how are we going to make sure that we're still like able to produce and do what we like to do?
I love that shield. I never heard that before.
Yeah.
Andrew and I have ratcheted up our health because, our I guess our health and exercise. We joined a boot camp. So
wow.
yeah, so from 11:30 to 1 o'clock every day, we go in this boot camp. And Kim, I tell you, the first day I almost passed out.
Oh my gosh.
Yeah, my heart rate went up to about 180. And yeah, and I had to really bow out for about 10 minutes from the class.
I bet.
Yeah,
I bet.
so
I bet. So how long have you guys been doing the boot camp now? Just for this month?
yeah, this month. Yeah, I think January 4th or so was our first day.
Good for you guys.
Yeah.
Good for you guys. And where's your max heart rate go now that you're like 3 weeks into this? Have you brought it down a little?
It's gone up to the 170s, but I've been able to manage it and maintain it and just embrace it. Put it that way. I've been able to embrace it. Yeah. It was just more of a shock to my system that first day.
Completely. It's just like anything. The more you train, you're like you look back and you're like, well, that was easy. but you remember that first day.
Oh my gosh,
well, that wasn't so easy.
I won't lie to you. I saw who the trainer was today, and she was the trainer from the first class. So I'm still having PTSD. So I kind of skipped today. But I'll be there tomorrow. I'll be there tomorrow.
I love it. I love it.
Well, Kim, thank you again for your time. Really appreciate it, and hopefully we can have you on again later on this year. Let's see if some of the I won't say the predictions, but some of your thoughts. Let's see how they play out for the rest of this year. And again, thank you and your team for putting this together. And I'm sure we'll see each other. Oh, we'll actually see each other next week, right?
Next week,
in Orlando.
We'll be in Orlando. Looking forward to seeing you in Orlando, and we've got big crew of our team that'll be down there. So definitely looking. So Andrew and you both will be there.
Yes, we'll be both be there. Awesome.
Good deal. Yeah, no. Look forward to seeing you there. And once again, can't thank you enough for the great partnership, and always love like catching up with you. So real fun. Thank you very much.
Thank you again. And thank you for joining us on Beyond Tomorrow. We'll see you next week.